Hi everybody, this is Gary Dean and this is our video report for Tuesday, February 23rd, 2016. So we had a pretty good break in the markets today and it actually stuck. And really, we still have to leave the door open, for a couple different things. One is that this was the wave B and we completed it. And the reason why we have to leave that open is, one, we ran right into the moving average. Two, we ran right into resistance, and we got a pretty good break from there. So we have to leave the door open that this was the top, and now we're starting the larger move to the downside. Now, the reason why we really can just have that as a possibility is because, yes, we broke the rising wedge here. That's bearish. But we look at really what the bears have to do is push the S&P through this 1895 and get the below the moving averages and stuff like that to really confirm that we are starting that wave C down. So I was saying that this, buying up here was dangerous for the reason that we had the bearish divergences. And you can see we're still pretty overbought right here. So we have, the 1909, and then we have this 18, what is it, right around the 1895. So these are your support areas, and what may happen is we may be forming some type of head and shoulders pattern where this is going to be the left shoulder, this is the head, so we come down, find some support right around that 1900 again, and we bounce back up to the 1930 to form the right shoulder, and then from there we would anticipate that we would break to the downside. So the bullish side is dangerous, and really what I'm more interested in at this particular point is using rallies to short. And if we get up to somewhere at these levels, take a short position. If it ends up going higher and say touching this resistance line here, then we just add it, because I'm pretty confident at this particular point that the next move is, and it's probably going to be the larger move, is going to be this wave C to the downside. So I'm not interested in trying to catch these, even if we do get a nice push up and catching this part of the move higher. I'd rather be looking to short it. And again, being that we stopped at the 50% retracement, we had bearish divergences and we're very overbought, we really have to leave, that this wave B, all we did was make an ABC of a wave B, and this is it, and now we're starting the next move down. But again, it's not, I can't say that with 100% certainty, and we may still chop around here for the rest of the week to make this wave C, and it may come up, somewhere up into that 1968. But again, it's not something that I'd be looking to buy. I'd be more interested, if it does come up here, in shorting it. And really what I want to do is see how this support level holds and just really short that counter trend bounce that most likely will happen at some point. But we still have these support areas, so I don't want to be jumping aggressively on the short side, especially if they hold, because it would be painful, especially if we head up here. So I'm going to remain a little bit patient, but I'm more leaning towards, we completed this and we're starting the next move to the downside. So what we want to keep an eye on is the 1909 and the 1895. These are your support areas that you would be anticipating that the bulls may try to defend. If they don't, then heck, we may be just heading down, and just have little moves off the lows and then just continue in a straight move down. But again, it's too early to tell whether that is what's going to be playing out or not. So another reason why I don't want to get overly bearish is just from these lows to these highs, and we haven't even hit a 23%. So yes, it was a big move down. It was different than this because we didn't get any rallies back up. So obviously we know that the markets are changing. And it's just a matter of when are we going to, when are things really, really going to start breaking down? And that's what I'm interested in. So we have 1915, which is just a 23% retracement. We still have plenty of room to go before we get into the completely oversold levels here. So a push down, into this area here, if it holds, then really what we would want to keep an eye on is the 1931 or the 1934. And as long as that gets held down, you want to short because most likely we're taking these lows out. So if we take a look at the 5-minute chart on bounces, what I would expect, I think really if we see the S&P get above the 1940, then we got to leave the door open that this is not the high. And we're still completing that wave B up. But right now, like I said, I wouldn't get too bearish at this particular point for the one reason that we haven't even taken the 23% retracement out, and we still have some support levels that need to be broken. But I would not be interested in buying dips here. I'd rather wait for the rally, see where that starts to stall, and then jump on the short side. So with that, let's see what plays out tomorrow. Some things are starting to get interesting, and that's about it. Have a great night.